Welcome to Simple Investing Secrets, your trusted source for valuable investment insights, stock recommendations, and strategies to help you achieve financial freedom. In today's video, we're going to uncover two tech giants that might just be the hidden gems you've been waiting for amid the recent market sell-off. Imagine turning a market downturn into your financial advantage. Sounds intriguing, right? So before we dive into these potential game changers, if you find value in this video, please support the channel by liking and subscribing to our weekly updates. Now, let's get started. With the market experiencing a downturn, many investors are reevaluating their strategies, and for a good reason. The recent sell-off has made some previously high-flying artificial intelligence (AI) stocks more accessible. While Nvidia remains a popular choice for many, its current valuation still leaves some investors questioning whether it's a worthwhile buy. Instead, today, we'll focus on two other promising companies that are emerging as great opportunities amid the market's turbulence: Alphabet and Meta platforms. Let's start with Alphabet, ticker Google. Known as the parent company of Google, YouTube, and the Android operating system, Alphabet is deeply entrenched in the digital world. While its name is synonymous with search and advertising, Alphabet's involvement in AI is significant. However, it's worth noting that the bulk of its revenue, 76% in the second quarter, still comes from advertising. This segment saw an 11% increase year over year, which, while respectable, isn't exactly groundbreaking. But here's where things get interesting: Alphabet's Google Cloud division. This cloud computing arm of Alphabet has become an integral part of its business, and it's growing rapidly, largely thanks to the surge in demand for AI. For investors, it's crucial to understand that companies developing AI models often lack the necessary storage space and computing power to train these models efficiently. Rather than investing millions in infrastructure, these companies can rent storage and computing power from Google Cloud, which has proven to be a highly successful strategy. This trend makes Google Cloud a key growth driver for Alphabet, with the division posting an impressive 29% growth in the second quarter. When analyzing Alphabet, one strategy to keep in mind is to look at the company's forward price-to-earnings (PE) ratio. With the S&P 500 currently sitting at a forward PE ratio of 22.2, Alphabet's valuation is relatively attractive. To complement this analysis, investors should also monitor the exponential moving averages (EMA) over 50-day and 200-day periods. If Alphabet's stock price crosses above these EMAs, it could signal a bullish trend and a potential buy opportunity. Combine this with technical indicators like the moving average convergence divergence (MACD), watching for bullish crossovers where the MACD line crosses above the signal line to confirm momentum shifts in the stock. Additionally, consider using the Relative Strength Index (RSI) to gauge whether Alphabet is overbought or oversold. An RSI nearing 30 could suggest the stock is oversold and may present a buying opportunity, especially during a market dip. These strategies can help in timing a buy and hold approach, particularly for those who prefer stashing away high-quality stocks like Alphabet for the long term. But before we proceed, here's a question: what do you think is the biggest challenge for companies relying heavily on ad revenue? Comment your thoughts below. Now let's turn our attention to Meta platforms, ticker Meta. Similar to Alphabet, Meta's revenue is predominantly driven by advertising, served across its extensive family of apps, which includes Facebook, Instagram, WhatsApp, Messenger, and the newer addition, Threads. In the second quarter, advertising revenue accounted for a whopping 98% of Meta's total revenue, growing at a robust 22% year-over-year pace. This performance is impressive, particularly in a saturated digital ad market. When evaluating Meta's valuation, it's trading at 23 times forward earnings. This might seem high, but it's quite reasonable considering the company's growth trajectory. For Meta, a forward PE ratio in this range, coupled with expected revenue growth between 15% and 22% in the third quarter, suggests the stock is reasonably valued. Investors can use this forward-looking indicator to assess whether the stock is trading at a fair value based on expected earnings. Like Alphabet, investors should consider using technical indicators like the RSI and Bollinger Bands to identify entry points. If Meta's stock price is approaching the lower Bollinger Band, it might indicate that the stock is oversold and could bounce back. Using the moving average convergence divergence (MACD) indicator can also help spot changes in momentum. Look for bullish crossovers as potential buy signals. Additionally, the RSI can help determine if Meta is in an overbought or oversold condition, with a lower RSI suggesting a potential buying opportunity. Furthermore, using the MACD indicator can also help spot changes in momentum. Look for bullish crossovers as potential buy signals. Meta has also been making strides in expanding its AI capabilities, which is crucial for its future growth. The company's management has indicated that expenses are expected to increase significantly in 2025 due to the escalating costs associated with building out AI infrastructure. While higher expenses can raise concerns about short-term profitability, these investments are essential for Meta's long-term success. For investors willing to take on some risk, the potential rewards could be substantial, especially especially as Meta continues to position itself as a leader in emerging fields like augmented reality and the metaverse. Let's also consider the exponential moving averages, EMA, for Meta. Similar to Alphabet, if Meta's stock price crosses above the 50-day or 200-day EMA, this could indicate the start of an upward trend. Taking a closer look at how Alphabet and Meta stack up against each other. Both companies are leaders in their respective fields and are well-positioned to benefit from the continued growth of digital advertising and the broader tech sector. Alphabet's strength lies in its diversified revenue streams and its growing cloud computing division, which provides a hedge against fluctuations in ad revenue. On the other hand, Meta's dominance in social media gives it unparalleled access to user data, a significant asset in the digital advertising space. However, there are also risks to consider with both companies. For Alphabet, a primary concern is its heavy reliance on advertising revenue, making it vulnerable to downturns in the ad market. Increased regulatory scrutiny, especially in Europe, could also impact its operations and profitability. For Meta, the biggest challenge is balancing its ongoing investment in AI infrastructure with maintaining profitability. The competition in the social media space is intense, and privacy regulations could limit its ability to monetize user data effectively. In summary, both Alphabet and Meta offer compelling investment opportunities, especially during a market downturn. By using a combination of fundamental analysis and technical indicators, investors can better time their entry points and maximize potential returns. Let's look at the table. Alphabet and Meta platforms have shown remarkable resilience in a challenging market environment, each leveraging their strengths to drive growth. Alphabet's 14% revenue increase is largely attributed to its booming cloud computing division, which saw a 29% growth, underscoring its expanding footprint in the AI-driven tech landscape. On the other hand, Meta Platforms delivered an impressive 22% increase in overall revenue, fueled by robust advertising sales across its vast ecosystem of apps. The company's 73% EPS growth and its forward-looking investments in AI position it as a leader in emerging technologies, with an expected Q3 revenue growth of 12%-20%. These financial indicators reflect not just stability, but also significant growth potential. Both companies are adapting to and capitalizing on new opportunities in AI and digital advertising, making them compelling choices for investors aiming to navigate and benefit from the current market volatility. Despite these challenges, both Alphabet and Meta offer compelling investment opportunities, especially in the context of the recent market sell-off. For long-term investors, these companies represent a chance to buy into two of the world's leading tech giants at a discount. With their strong growth prospects and solid financials, Alphabet and Meta are well-positioned to deliver substantial returns over time. But before we go, here's a question for you. If you could invest in one tech giant right now, which would it be and why? Comment your thoughts below. If you found this video helpful, don't forget to like it and subscribe to our channel for more content like this. And remember, this video is for informational purposes only and is not financial advice. Always consult with a professional before making any investment decisions. By following these strategies and staying informed, you can navigate the stock market with confidence and work towards achieving your financial goals. Thank you for watching Simple Investing Secrets. Until next time, happy investing.